Today we're going through, in my opinion, one of the best methods to invest your money, and that is through the use of index funds. These are brilliant for those of you that want a set and forget type of strategy. Basically, no stress. And it's even a strategy legendary investor Warren Buffett swears by and says that, quote, the average investor should put their money in a low-cost index fund. And if that's what one of the greatest investors of all time recommends, who are we to argue? By simply investing regularly in index funds, your wealth will grow over time. Just bear in mind that this is a long-term investment and definitely not a get-rich-quick thing. Like, your portfolio isn't going to double over the next 12 months. But if you are the type of person that likes getting rich slowly and steadily, then this strategy is for you. In this video, we're going to cover 1, the difference between index funds and mutual funds, and 2, my personal top 5 index funds. Now, these 5 funds could change next year or over the next few years, but this is my updated list for 2024. Now, I do want to emphasize that this video doesn't contain any financial advice, but if you do watch the full video, you're going to understand more about investing and importantly be more self-assured with the fund or funds you choose to invest into. So before we start, a brief definition of an index fund. An index fund is a type of investment that you can buy with a brokerage account. And an index is a list of companies like the FTSE 100, and the FTSE 100 contains the top 100 companies in the UK, like BP for example. The index fund is a pot of money that buys the businesses on that list and looks to track the performance of that index, or match the performance, should I say. We probably need to go a bit deeper. Let's say you have £10,000 to invest and you join with 99 other people who have £10,000 to invest. That pot of money comes to a total of £1 million. The fund manager, you could say money manager, would be in control of that money, that £1 million. His or her job would be to invest in a variety of stocks, bonds or other investments on your behalf. The manager chooses certain investments to get the highest possible return for his or her clients. In this case, you and the other 99 investors. And for this service, the fund manager will charge a fee. And fees are something us investors should be acutely aware of. The difference between index funds and mutual funds. Index funds aim to track a specific index like the S&P 500 in the United States or the FTSE 100 here in the UK. As I've mentioned, they passively manage their portfolios. Take the fund I invest into, for example. That particular fund is managed by a group of Vanguard global advisors. The index fund's aim is to replicate the performance of a certain index by holding the same securities in the same proportion as the index. So if your index fund tracks the S&P 500 this year and the S&P gets returns of 10%, your fund will also get returns of 10%. Mutual funds, on the other hand, are actively managed by a fund manager who makes decisions on what securities to buy and sell within the fund. By the way, security is a tradable financial asset. The manager of the mutual fund is looking to outperform the market. Simply put, an index fund is designed to track the market, but a mutual fund is designed to beat the market. Looking at costs, index funds have lower management fees compared to actively managed mutual funds. Performance-wise, index funds will beat most mutual funds. For example, in 2021, 79% of fund managers underperformed the S&P 500. You do get some mutual funds that will beat the market, but they aren't many, and it's picking the right one. All I would say is that most experts recommend index investing instead of mutual funds. I've read over 200 investing books since 2019, and this has been a common theme with the books that I've read on this very topic. That came up time and time again. Experts like John Bogle, Warren Buffett, Paul Tudor Jones, and many more. My personal top 5 index funds. Number 1 is a product I really like, and that is Vanguard's FTSE Global All Cap Index. With this fund, you get an access to over 7,000 stocks, and the annual fee is only 0.23%. In terms of risk, it's fairly high risk, as it gets a rating of 5 out of 7. I like this fund's holdings. Currently, the top 10 positions include the likes of Apple, Amazon, and Nvidia. You're also getting a good mix as the fund provides exposure to large, medium and small companies. One issue to be aware of here is that around 60% of the fund is allocated to the US stock market at the moment, at the time of this video. This could be seen as having too much exposure to the US market. Let's say that in a given year, US shares didn't do very well. In this case, this fund would probably underperform. Now, I was going to do a quick video of me looking at each of these 5 funds, so you can sit like on the Vanguard website, so you can see it visually, and to give you an idea of what to look for when you're choosing an index fund or funds. But that's probably it's going to get a bit repetitive, a bit boring. And trust me, the last thing I want to do is lose your interest. I don't want to bore you. So here's what I'll do instead. After I've told you my top 5 index funds, I'll do a quick video where I'll look at the Vanguard website and I'll have a good look at the fund I invest into and show you some of the things to look for when you're choosing your fund, your index fund. This will finish the video nicely and help to make things a bit more straightforward for you, because I'm all about keeping things as simple as possible. Number 2 is Vanguard Emerging Market Stock Index Fund. This has an ongoing charge of 0.23% and provides exposure to around 1,400 large and mid-sized companies in emerging markets. So not quite as diversified as the previous fund, and it's also higher risk, as Vanguard gives it a risk rating of 6 out of 7. But I do like this product as it has a decent amount of exposure to China, like 25% of the fund. Chinese stocks are well off previous highs, so there is a fair bit of room for decent returns, in my opinion. And in the back of my mind, I'm thinking the Chinese yen might just become the global reserve currency in years to come. But take this with a pinch of salt, it's just an opinion. I just don't think the US dollar's dominance will remain forever, shall we say. Another plus is that it has a large exposure to India, and the Indian economy is a strong economy. Both China and India are economic powerhouses, so getting exposure to both is a big positive. I just think this fund is worth your consideration. Number 3 is the Vanguard Target Retirement 2050 Fund. The Vanguard Target Retirement 2050 Fund is designed for investors who plan to retire around the year 2050. The fund's objective is to provide investors with a diversified portfolio of stocks and bonds that becomes more conservative over time as the target retirement date approaches. The 2050 fund provides exposure to over 23,000 assets, so this is hugely diversified, and this is a big plus for me. Risk-wise, it's 5 out of 7, and the ongoing charge is 0.24%. The Target Retirement 2050 Fund is designed for investors with a long-term investment horizon. By investing in a diversified portfolio of stocks and bonds, the fund aims to provide investors with the potential for long-term growth and income. I think if you want to keep things really simple, this is definitely an option. The beauty of the Target Retirement Fund range is that you can choose a rough year like 2050, 2045 or 2040. This is dependent on your age and what your investment goals are. Number 4 is the Vanguard Development World All Cap Equity Index Fund. This fund is made up of large, mid and small cap stocks of companies in developed markets around the world. So you might see it as a bit of a safe option. It has an ongoing charge of 0.2%, which again is low. Low costs are one of the main benefits of Vanguard index funds. It has a risk of 5 out of 7, so I would only go with this really if you have a decent appetite for risk and you're prepared to invest for at least 10 years. It has exposure to over 4,000 stocks, so it's well diversified. One of the big pluses for me at the moment is that it has a large exposure to the US market, and that is 75%, but that is only for the time being. As I mentioned before, the US dollar's dominance won't go on forever, in my humble opinion. Certainly a fund to consider though, and a really strong fund for the year 2024. Number 5 is the Vanguard Life Strategy 100 Fund. The Vanguard Life Strategy 100 Fund is designed for investors seeking a diversified portfolio with a high allocation to equities. This is the fund that I've invested into for the last few years, since 2019, and I've had decent returns. This fund gives you exposure to over 7,000 stocks. In terms of cost, it has an ongoing charge of 0.22%. The low costs are what first attracted me to Vanguard index funds. I mentioned cost over and over again. It's really important, a big part of index investing. Risk-wise, it has a risk of 5 out of 7, so fairly high risk, which suits me as an investor because I intend to invest for the next 20 years. The Life Strategy range has a few different options, like the Life Strategy 80 Fund, which is 80% stocks and 20% bonds. When I was doing my initial research back in 2019, I was torn between the target retirement and life strategy options. Now, as promised, we are now going to have a good look on the Vanguard website at the fund I currently invest into. So here we are on the Vanguard website. This is the fund, the Life Strategy 100% Equity Fund that I've been investing into since 2019. I go for accumulation, so any dividends earned is reinvested. If I was in my late 50s, for example, I might go for the income option. So you're getting the dividends each month. Looking at the overview, you've got the price, the asset allocation. So this particular fund is 100% equity. So it's all shares, there's no bonds. The OCF, the ongoing charge, is 0.22%. And you've got a risk which is 5 out of 7. This is medium to high risk, which suits my risk tolerance. Then you've got the objective, which describes what the fund does, like the fact that it's got 100% shares. You've got past performance. So looking at the last 12 months, you've got a return of 16.24%, which is good, obviously good. Then you can go further into price and performance, portfolio data, distributions, cost and minimums. For example, if you look at the portfolio data, it will tell you exactly how it's allocated. So 19.7% is in US equities. So if you're a fan of US equities, this is a good thing. Then you've got 19.6% in UK All Share Index. You've got Developed World, UKITS ETF, Emerging Markets, etc., etc. You can get all this information in the Key Investor Information. So just click on that, and this tells you exactly what you need to know all about the fund. My genuine belief is that index funds will be a welcome addition to anyone's overall portfolio. So if you like the sound of any of the index funds from this video, do some further research and see if they are for you as an investor based on your risk tolerance and your financial goals. Please remember that this video isn't financial advice. It's just information from me to you that will hopefully save you a lot of time. If you're not sure how to buy index funds or you want some more information, see below. There I've included some links that will give you further resources that will help you to safely invest into the stock market. That's it for the time being. Good luck with your investing, and thanks for taking the time to watch this video.